Welcome to Sectors Up Close. I'm Elena Casas. Today our topic is UK Real Estate Investment Trusts, or REITs, and my guest is Russ Mould, Investment Director at AJ Bell. This sector was once a darling of yield-hungry investors. Now many REITs are suffering from the twin problems of empty offices and high interest rates. The FTSE 350 Real Estate Investment Trust Index is down 10% this year alone. That compares with a 2% decline for the broader 350, which tracks domestically focused companies. According to research provided to us by AJ Bell, it's 27th out of the 39 industry groups that make up the index. So, are there any bright spots in this sector outlook? Let's ask AJ Bell's Russ Mould. Let's start then with the macro picture. You mentioned retail's closing down, empty offices, the struggling UK economy in your notes. Is there a brighter future here?
It's not a desperately pretty picture, is it? But there are some subsectors that are continuing to thrive. Segro, which is a FTSE 100 company, just raised £900 million from its investors through an issue very quickly, very easily. And it's a major warehousing and logistics player, for example. So there are areas that are very strong. But you're right, there's a lot of shares that have struggled for a very long time, certainly since the pandemic, because of the rise of working from home, the ongoing battle that bricks and mortar retailers have got. And yes, eventually the UK has tipped into that long-awaited recession. Bank of England's continuing to say, don't worry, it'll be a shallow one. But investors understandably now worried about rising voids or vacancies and whether there'll be any pressure on rents. Just when you're seeing some REITs, even office REITs, showing increased activity in new lettings because they've got some brand spanking new buildings to let out, which at the moment it seems tenants are quite keen to move into.
Historically, this, of course, was a yield play. Yeah. At the moment, the index is 4.79% yield. Doesn't compare very well with two-year gilts at 4.3%. So are investors needing to wait for the Bank of England before thinking about this as a serious investment?
I think that's a major development that would be very, very helpful for the sector. If you look during that 10 or 12-year period of 0.5% interest rates we had in the UK, the sector did incredibly well. Investors were falling over themselves for almost any source of yield, and property was very much one of those. Real estate's in the vanguard. They have to pay out 90% of their income as dividends to maintain their tax-free preferential status. So they were a big yield play, and you're right. If you can get 4.1% from 10-year gilts, more than that from 2-year, in theory, risk-free, and I stress in theory, or even cash in the Bank of England's base rate is 5.25%. Real estates just don't look quite so attractive. So lower base rates, lower bond yields might bring these stocks back into play.
Since they're so unloved now, does that mean they're undervalued?
Well, as somebody who's is a Yorkshireman, therefore natural paid-up member of the awkward squad, I'm always trying to think about what the market's missing, and very few people are asking about REITs right now, which is quite tempting. Thinking back to the post-Brexit voting period in 2016-17, lots of these companies were trading at 25 to 35% discounts to net asset value, and then soared very strongly as the economy didn't drop into a hole after the referendum. I'm not saying that the economy is as strong now as it was then, but the discounts are even bigger to NAV in some cases, like at Derwent London or British Land or Land Securities. So that is interesting again, if the economy doesn't prove to be as bad as people fear, and indeed you get something of a move back to the office, which we're seeing signs of, and you get those rate cuts. So the valuations are pricing in an awful lot of bad news.
We clearly need to pick and choose here, though, in terms of the types of real estate that these companies hold. You mentioned logistics and warehouses as a strong point, of course, after the boom in online shopping. Where else are there bright spots? Well,
student housing is a big one. Unite actually trades at a small premium to net asset value. So that trades at 5% premium. Then the biggest discounts you've got are down at 50% with Hammerson, a pure retail play. So there's a very, very wide spread. Generally speaking, and there are always exceptions, student housing, warehousing, specialists like data centres trade very close to NAV or much closer. Healthcare somewhere in the middle. Big offices, skyscrapers, big London property developments and retail, much bigger discounts.
The outlook, though, for those big London property owners is quite varied depending on the company, though, isn't it?
It is. I mean, again, Derwent London is trading on about a 35, 38% discount to NAV. Shaftesbury Capital a little bit bigger. Land Securities in the 30s. But they are, again, they're not identical companies. They have different mixes in terms of their client base. Derwent London, Burberry is one of its big, Expedia, a big customer. The UK government is a tenant. And even there, you've got people going back to the office somewhat under duress, perhaps. So, again, voids are coming down in most of those businesses. If they can now sustainably prove that voids are coming down, the rents are coming in, and it's the rents that pay the dividends, not asset valuations, that is something that may make people at least think about reassessing their bearish view of the situation.
Russ Mould of AJ Bell, thanks so
Thank you.
much for that contrarian look at UK real estate investment trusts. And that's your roundup of that sector. I'm Elena Casas, and this is Reuters.